This is the first video in our course on applied financial statement analysis, and this is going to talk about Unit 1, which is essentially a recap of financial statements. We would have probably studied a little bit about these financial statements in some of our earlier programs, and we're going to kind of quickly recap that because that is going to form a framework of the overall understanding on how financial statement analysis follows. Primarily, the agenda during the course of this set of our videos would be in Unit 1 would be around basics of financial statements. What are the various financial statements? A quick understanding on balance sheet, profit and loss account, and cash flow statements with respect to also individual items and what are the various line items here. So we are going to discuss the line items here. When I say line items, we'll look at live examples of companies and discuss each of the terms that come across these statements as we go along, right? Secondly, we're going to also do a short exercise on linkages of financial statements so that we know the impact of decision making on all these financial statements, right? So when a company makes any kind of decision, which of the financial statements changes, how does it change, what is the overall impact of that on the business is what is going to get covered here as well, right? So primarily the objective of this entire unit is to one, go through and recap very quickly the three financial statements, quickly understand what is the impact of decision making on those, and then look at some Indian companies and their examples and try and kind of gauge how do these numbers stack up, right, for those companies. With reference to those companies, we'll get more data, more clarity about some of the line items, which we may not have covered as yet, right? So that's what is going to be the agenda of this particular unit. This is going to be broken into multiple videos. The first video is going to start with basics of what financial accounting and financial statements are, and then we take individually the balance sheet, the profit and loss account, and the cash flow statements. Now, what is accounting and why is it important? Now, accounting is the process of identifying, gathering, measuring, and communicating the financial information about a company's operations. So you have to find out the data, find out what data has to be covered, then you have to gather that data, measure the data, and then communicate it in the format, a certain framework that everyone finds easy to comprehend and understand. It is essential to business decision making and monitoring of the activities of the business. Two main purposes thus for accounting are to report the financial position of the company, how is the company doing, and then to assess the performance of a company vis-a-vis a defined period, let's say last year or this year. So is the company improving or not improving, right? So both these data points kind of come and get measured. One of the most common metrics of performance measurement is the profit that the company makes at the end of financial years, right? So that's the yardstick by which most companies get measured. You could also look at yardstick like sales, you could look at yardsticks like cash, you could look at yardsticks like assets, and finally, the most common yardstick is profits because the purpose of businesses is assumed to be making profits, right? So that's the broad spectrum of what is accounting, why does it become important, and how do we go about kind of looking at these data points. Now, when you're looking at a particular company, you have to understand also the concept of what is called as a financial year. Right now, you will have to eventually break down the performance of the company in terms of periods. So you either take a monthly performance or a quarterly performance or a half yearly performance or an annual performance, right? A financial year is nothing but any 12-month period used for accounting. There is no hard and fast rule on what 12-month period has to be used. Any 12-month period could be used. Any continuous 12-month period has to be used to be considered as what is called as a financial year. This may or may not coincide with a calendar year. So it is not necessary that it has to be January to December of a particular year. Different countries follow different financial years. US usually follows Jan to December. So most of the developed nations kind of follow this. India, on the other hand, follows something like April 1st to March 31st. Generally, most Indian companies follow this. That doesn't mean all of them have to follow. You could have companies that follow an accounting period of October to September. So October in one year to September of next year. In this calendar, you will see the year starts in April. So quarter one becomes April, May, June. Quarter two of the financial year becomes July, August, September. Quarter three of the financial year becomes October, November, December. And consequently, quarter four of the financial year becomes Jan, Feb, March of the next year, right? So if this was 2015 and this was 2016, what is commonly called as a financial year is financial year 2016. This is the quarter one of 2016. This is the quarter two of 2016. This is the quarter three of 2016. And this is the quarter four of 2016 financial year. So the concept of financial year is important to be understood. When we say Q1 financial year 2016, that is typically April, May, June of 2015, because most companies in India follow the period between April of a year to March of the next year. So let us revalidate this. If this was 2015 and this is 2016, essentially when we say financial year 2016, this would be from April of 2015, and that's 1st of April 2015 to 31st March 2016. That's the financial year. This here is going to be quarter one. This here is going to be quarter two. This one is quarter three. And typically you could write FY16, quarter two FY16, quarter three FY16, and this would be quarter four FY16. Now, that does not mean that other companies cannot follow the different financial years. Consequently, this here would become quarter one FY17, right? So from here, this portion is FY17 that has started, right? That doesn't mean, as we said, however, that a company cannot really follow another financial year. If a company is following a calendar year, it will be from January to December. Companies could choose to follow July to June. They could choose to follow October to December. So if a company is following, let's say October to September, sorry, then the period that will get established is this is going to be quarter one, and then these 3 quarters of next year are going to come in. Quarter is 3 month periods, right? So quarter three, quarter four. Essentially, that's if a company is following an October to September accounting year, right? So that's how accounting years or financial years are kind of told. For our purpose, most of the times we'll find that about in 90% of the companies we'll see April 1st to March 31st as the financial year as we go along, right? Now let's look at these three statements or financial statements that get created and the respective usage of these three statements. So we have three of them. We have profit and loss account, we have cash flow statement, and we have a balance sheet, right? As we understand this, basically, the premise here is that a profit and loss account is going to tell what a company earns through business and what is spent to kind of procure that business. So earning versus costs is going to come in the P&L statement, profit and loss statement, also known as the income statement. This is also called as the income statement, right? Then we have something called as the cash flow statement. Sometimes and we will look at what cases those are. It is possible that the profitability of the company, the sales of a company, the spending of a company is not exactly cash in nature, right? Any money coming into the company versus money going out of the company, and here we are talking about cash as such, coming into the company and going out of the company, is recorded in the cash flow statement. That's the use of the cash flow statement. And as we understand this further, we will get more clarity on these statements and what is the requirement of these statements. And finally, you also need to know what are your liabilities or obligations in a business. So if you have to repay someone for certain goods or services procured, or for funds taken from them, that is a liability. And any resources owned by the company, tangible or intangible. Tangible means what can be seen, which have a physical presence, like a building. Intangible is what may not be seen. For example, a brand value. Or, for example, a company may have patents or licenses. Take, for example, a radio company or a telecom company.